All right, so chapter 7, we are concentrating mostly on petty cash and then the bank reconciliation. There are going to be a couple things on internal control, but I don't think I really need to go over that. So let's talk about some of the petty cash problems. So first of all, we're going to do 7-5 petty cash. So let's go ahead and establish a petty cash fund. So when we're doing a petty cash fund, this is going to be the only time that we're actually ever going to use a petty cash account. So we're going to increase our petty cash by $200. So unless you are establishing a petty cash fund or increasing a petty cash fund, this will be the only time that you are actually using a petty cash fund. And then you're going to decrease your cash because the cash that goes into your petty cash comes from your bank account. So that's your March 1st entry. And then the petty cash fund has 19 in cash, 188 in petty cash tickets that were issued to pay for office supplies, entertainment expenses. And let's go ahead and replenish that fund. So let's talk about what we have to do to go ahead and replenish that and make the entry. Well, what we need to think about is we started with 200. So we have 200 and we end with 19. So theoretically, we should have $181 in receipts. We have 188 in receipts. So something went a little askew there. So let's talk about what we need to do. Let's start with our entry. So the first thing I want to do is I want to think about how much I need to put back into my petty cash fund. And I'm going to credit my cash. And I know that that's not the first thing you typically put in. You usually do a debit, but let's go ahead and credit our cash with how much we need to put in. Well, we need to go ahead and put in, like I said, $181 in cash. Then let's go ahead and record our expenses. Well, we said that we had office supplies. That's not an expense, that's actually an asset, but of 68. And we also had entertainment expense, and that was 120. Let's go ahead and look at our journal entry here. So we have 188 here and 181 here. So clearly this journal entry doesn't balance. We're going to need $7 on the credit side in order to make this balance. And that's because something happened with our receipts and our cash that did not make it balance. And we're going to call that a petty cash over under. And regardless of whether it's too much or too little, you still put it in the same account because theoretically it should wash out. So we said that was $7, right? So now we should have 188 in each account. And we do. So this is how I'm going to go ahead and reconcile my petty cash fund. So now I'm back to $200 and I've recorded what I've spent my petty cash on, and I have this petty cash over under account. So let's go ahead and see what happens next. We're going to go ahead and increase the petty cash fund to $250. So I already have 200 in there. I'm going to go ahead and increase it to 250. So again, the only time you use petty cash accounts are when you are establishing a petty cash account or when you are increasing or decreasing it. So I'm going to increase it by $50. So now I have 250 in my petty cash, 200 here and 50 here. All right, so let's talk about 7 for a minute because this is the first part to the bank reconciliation. And a bank reconciliation, I think, can be confusing to a lot of students. So what happens is you get a bank statement from your bank for, let's say, February 10th. You get a bank statement as of January 31st, and it has an ending cash balance. Well, you as a company also have an ending cash balance based on the records that you are keeping. And there are going to be differences. And these are the typical differences that you are going to have. So when you get that bank statement, you need to reconcile that bank statement, and you need to update your records, and you need to update the bank's records. And based on those changes, you should have the same amount on each side. So what we want to do is, in this case, we're going to talk about each one and what we need to do with each one. So A is a deposit in transit. And what that means is, let's say you went to the bank January 31st and put a deposit in. Well, if those bank statements are printing out February 1st, that means that more than likely that deposit did not get on that statement. So that's something you knew about, the bank did not know about. So you're going to have to add that to your bank side. So what I'm going to do is, let me erase this since we've already done this one, is I'm going to have a bank side and then I'm going to have a book side. And so I'm going to add it a deposit in transit over here. Okay, something that you already knew about, you've already added it to your side, but the bank has not. So bank collection, what a bank collection means is that they are kind enough to take money on your behalf, like an EFT or Venmo or something like that. So let's go ahead and add that over here. So a bank collection. A debit memorandum. Well, let's put that aside for a minute because we're going to talk about that later, because that can be a little confusing. So an EFT cash receipt, very similar to a bank collection, electronic funds transfer. An EFT transfer. Outstanding checks. So what outstanding checks mean is those are checks that you have written, you know about them, you have subtracted them from your side, but whoever you wrote them to has not deposited them or has not cashed them yet, so your bank doesn't know about them. So it's something you have subtracted on your side, but the bank has not. So I'm going to go ahead and say outstanding checks. So you're going to have to subtract them from the bank side. $1,000 deposit erroneously recorded by the bank as $100. So what has happened is the bank has added $100, you have added $1,000. So you have correctly increased your cash by $1,000. The bank has incorrectly increased your cash by 100. So you need to increase the bank side by the difference. So you're going to go ahead and increase, by the way, this hardly ever happens, by bank error. And obviously that can go either way. Service charges. So service charges are bank fees that the bank charges. Now, for the sake of this chapter, or even for the book, these are charges that you don't know about until you get the bank statement. So obviously, if you have online banking or anything like that, you will probably realize that you get those in real life. But for the sake of this chapter, you don't know that until you get those statements. So that's something that you are going to have to subtract on your side. And that's going to be a subtraction. Interest revenue, revenue that you receive just by having the bank, your money at that bank. And again, that's something theoretically that you wouldn't know until you get that statement. $2,500 cash payment for rent expense erroneously recorded by the business as $250. So we deducted $250 in cash. We should have deducted $2,500. So we need to go ahead and deduct the difference. So put a plus there. I'm going to say error, and you're going to deduct the difference. And then a credit memorandum, and again, we'll talk about that in a minute. So those are the major issues that we need to talk about when we're doing a bank reconciliation. So let's go ahead and do the next bank rec, which is 7-8. So this is our company, Safety Security Systems, and we had a balance of $2,450 as of December 31st. And then we have the bank statement, and that's theirs. So obviously there's a big difference. So what I would do is, let's go ahead and make this a little bit smaller so we can see what we're doing here. So I would have the book side and the bank side here. Now, the book side, we had $24.50. There were outstanding checks, which goes on the bank side. So we know the bank has $44.60. So we have negative $1,700, and that's for outstanding checks. And a deposit in transit of $300, so we're going to add $300. The bank statement had this amount, and there was a collection of $620, so we're going to go ahead and add that. That's something we didn't know about. And they also show us $20 service charge. So they charged us $20 just for keeping our money there. So I'm going to subtract that. And $10 of interest income. So I'm going to add that. So I'll say this is a collection. This is a bank fee. This is interest revenue. And it looks like that's it. So hopefully these two will balance out, and they do. So what happens is at the end, these two numbers should match. The other thing to keep in mind is now you're going to have to make journal entries for these, those that you didn't know about. So let me do that real quick. So for our collection, we're going to increase our cash by $620. We're going to lower our accounts receivable by $620. For our bank fee, we're going to have we'll call it bank fee expense, and that was $20. We're going to lower our cash $20. And then we're going to have interest revenue. So we have, let's increase our cash by 10. We have interest revenue 10. All right, so this is your bank reconciliation.